Okay, welcome back to commercial banking. We're going to move ahead into chapter 6, which is measuring and evaluating the performance of banks. How are banks doing? Actually, two pieces to this chapter. One is looking at stock valuation. What should we pay for a bank stock or for a banking company? And then the other half has to do with these performance measurements or metrics that we use, these tools that we use, so that we can compare banks against one another and compare a bank over time to see trends in their performance and to see how these banks stack up against each other. All right, exciting stuff. I know you're ready for it, so let's move forward. Here we go. Strap in. All right, so a fair evaluation of any firm's performance should start by evaluating whether the company has achieved the objectives set by stockholders and by managers. You know, it's so easy to get caught up in day-to-day activities that we forget the big picture. Why are we in business? It's really important to keep your primary objectives, your mission, in the forefront of your mind, because all of your decisions and tactics and strategies should be related to what your central objective or mission is. Okay? So what should your objectives be, particularly as it relates to banking? Okay? Well, how large do you want your bank to become in terms of assets, in terms of revenue, the size of the market area that it services, how many employees do you want to have? It's good to have in your mind some idea of how large you want these things to grow to, because quality of life is important and you want to be realistic in what your goals are. All right, how much risk do you want to take in terms of the loan portfolio? What are you comfortable with? Okay, in terms of the securities portfolio, how far out on the risk spectrum do you want to get? How aggressive do you want to be with the rates that you're going to pay to attract deposits? Okay, how will you fund the purchase of assets? In other words, how much leverage are you going to use above and beyond deposits? How much borrowing are you going to do? Okay, what do you want the reputation or image for your company to be? Okay, and you know, a lot of companies have the same ideas about a lot of these things. Okay, are you going to focus on customer service, efficiency, employee satisfaction? Well, the answer is yes, yes, and yes. Okay, these things are all PR spins. These are all things that companies say. Their question is, what will companies really do? Okay. And how do you want to be known with regard to your lending policies? Do you want to be known as a bank that is reasonable? Do you want to be known as a bank that is very conservative? Or do you want to be known as a bank that is very aggressive with your lending? Let me check, just want to make sure that we're, yes, the red dot is on. Do I have a red dot right here on my forehead? All right. Okay, so all firms have the same objective, which means all employers and all employees have the same objective as well, and we learned this in managerial finance, which is to maximize the value of the company stock. That is why you're in business. Stock is equity, equity is ownership, and each person in the organization should be working to maximize the value of the stock. Okay? Doing this rewards those who provide equity capital to the firm. Okay? So people who risk their money are supposed to get the highest and first return on their money. But I would remind my capitalist friends, particularly my capitalist friends in state capitals and my capitalist friends in Washington, D.C., that business is a partnership between suppliers of capital, the money people, and employees. They're just the little people who work at the company and get the job done. Okay? It's true that capitalists risk their money, and they often also work at the company, so they risk their time as well. Okay? So the capitalists need and deserve to get a return. But a business cannot be successful without dedicated and talented employees, and I'm talking about employees at all levels. Okay? So be sure to reward people in your company in ways that are commensurate with their contribution. I can tell you story after story after story about companies that have employees that do things that contribute very significantly to the efficiency, to the cost saving, to the revenue generation of their company, and they don't get paid to do that. They don't see any extra reward, but the top level managers sure do. And this creates civil unrest because we all know fair and unfair when we see it. Okay? So we've got to make sure that we address these fairness issues. All right. So how do you maximize the value of a stock? We're going to get down and dirty with finance from a practical standpoint. The price of a publicly traded stock is the interaction of thousands or millions of investors. Okay? People buying and selling. From a finance theory perspective, equity value is derived as expected future cash flow or dividends divided by the discount rate. Okay, so these are the items that determine what a company is worth. Expected future cash flow, how much and when, divided by some discount rate. Okay? And the discount rate in turn consists of two components: a risk-free rate of return and a risk premium. Okay? So, value, what something is worth, is a function of three things. Expected cash flows, okay, that we derive from the financial statements, the market rate of interest, and company risk. Okay? So these three things put together will determine what a company is worth. Let's refine this just a little bit, and it's important. Employees and management doesn't have a whole lot of say over this. They have a lot of say over this. All right, the value of a firm's stock will rise or fall in response to actual, expected or actual changes in the value of the future sales, margins, cash flow, earnings, and dividends. These are fundamentals. And as information comes out that helps us see the likely future path for these items, the stock price should fluctuate. Okay? And actually, any time an actual change is different than what the expected change is, that's when big changes happen in the stock price, big movements in the stock price. All right, changes in market interest rates. This is a function of inflation, which we haven't had in the United States since 1982-83, and had much inflation. It's a function of government budget deficits, which we've had huge government budget deficits, and economic momentum. And we know that inflation has a positive relationship with economic momentum, and it also has a positive, rising interest rates has a positive relationship with budget deficits. All right, and then expected or actual changes in the level of risk. So what's going on today with this coronavirus scare? I'm going to go ahead and date this video that we're doing. We're right in the middle of the coronavirus scare. Some of what's going on in the marketplace is that cash flows over the next 2 or 3 or 4 or 5 or 6 months, or maybe even 12 months, because if we're having the pullback in economic activity, and then that will be followed by a rebound. So the economy is going to be affected for quite some time into the future. So the cash flows, or estimates of cash flows, they're changing, but also people are scared. And so the risk premium has gone up, which means people are willing to pay less for stocks. All right? So risk is also related to competition. The more competition we have, the riskier things get. The supply of labor, right? Leverage employed at the company. Regulations, a big risk, okay? And we see the difference in a Republican administration and a Democrat administration in terms of regulations and also in terms of taxes. Okay, so these things affect the level of risk for companies. All right, so how do you use this equation to come up with a stock price? Okay, so what we're doing is we're going over theory, but we're going to go over a practical way of doing valuation following the theory. But you need to understand the theory first. So if dividends or free cash flow are expected to grow at a constant rate over time, going back to Manfin again, the stock price equation can be simplified as follows. PO equals D1 divided by K minus G. Okay, so now what we're doing is we're introducing G into the equation. Whoops. There we go. All right. So PO is the theoretical stock price at the present time. D1 is the expected dividend 1 year into the future, which is your cash flow. K is the discount rate, reflecting the risk-free rate of return and a premium for the perceived level of risk. Okay? G is the constant growth rate at which all future stock dividends are expected to grow each year. So let's look at an example. A bank paid a dividend of $1.50 last year. They expect to grow dividends 6% every year. The required rate of return is 9%. Okay? So this is off the bank's financial statements. This comes out of their finance and marketing departments. This comes out of the marketplace, the required rate of return. Okay? PO, what should we pay for the stock today, is last year's dividend times 1 plus the growth rate, which is next year's dividend, divided by the required rate of return minus the growth rate. And the answer is $53. So this is a nice scientific equation, but it only works if we're right about our forecast growth rate, and if we're right about our required rate of return. Okay? And there's a lot of guesswork that goes into these two numbers here. Okay? So we're going to look at a different way to come up with a stock price. But let's keep this in mind. $53 is the price that we came up with. All right. The two formulas that we've looked at assume that the firm will pay dividends indefinitely into the future, but most investors have a limited time horizon. You buy a stock at a certain point in time, and then you expect to sell it at a certain point in time. All right, we call that end periods. And so if you buy the stock and hold it for a certain number of periods, you will receive a dividend for each period, and then you expect to sell the stock at a certain period. Okay. So what will you get for the price? D1 over K minus G. Okay. So under this scenario, a fair value for a stock is the present value of all the dividends plus the present value of the price of the stock that you'll receive at the end. What is this? This is a supernormal to constant growth problem. Okay? That's what this is. So find the present value of the dividends and the present value of the price expected to be received when you sell the stock. All right, let's see what we got here. Let's get a little more practical. Here we go. Now, I've set the stage with the theory, and now we're going to go into the how it's really done mechanically on Wall Street by investment firms. And then you'll see Andrew following this method in his conversation on analysis in the video that I've posted. Okay, so the previous stock valuation models use a discount rate to find the present value of dividends. Okay? A more standard way to value stocks is to identify fundamentals other than just dividends and then apply multiples. Okay? So the fundamentals typically of banks valued on Wall Street are earnings per share and book value per share. And Andrew mentions that in the video. And most analysts will focus on earnings per share to get a fair value, and they'll focus on book value per share as kind of a stopgap or a support level below which the analysts don't expect the stock to get. Okay? So this is kind of the rock bottom price for a stock, and this is the more likely a fair value. All right. So multiples, how do you find a multiple? You put the stock price of the company being valued or of comparable companies in the numerator and the fundamental, earnings per share, book value per share, in the denominator. That's how you find the multiples. So you have to use the marketplace and you have to use the financial statements from the companies themselves. All right. Please note that there is a relationship between the discount rate and the multiple. The multiple is the inverse of the discount rate, or of the discount rate minus the expected future growth rate of fundamentals. So let me explain with an example here. All right, for example, if the discount rate is 12%, D1 over K minus G, K is 12%. That's your discount rate. Okay? The expected growth rate is 5%. Okay? Without the growth rate, you're going to divide the dividend by 0.12. But with the growth rate, you're going to divide D1, because D1 is going to be 5% higher than D0, and you're going to divide it by 12% minus 5%. This 5% growth rate greatly increases the value of the stock. Okay? So what does it do to the multiple? Well, the inverse is 1 divided by this. Okay? So 1 divided by 0.12 is 8.12, I think. But when you throw the growth rate in, 1 divided by 12% minus 5%, which is 7%, is 14.29. So because of the growth rate, instead of paying a multiple of 8, you're paying a multiple of 14. Okay? So you multiply the 14 by the earnings per share you expect next year, you get the stock price. Okay? So what are you trying to do? You want that number to be as high as possible, and you want that number to be as low as possible. All right, the higher the discount rate, the lower the multiple. The higher the growth rate, the higher the multiple. Okay? All right, let's look at an example of valuing a bank stock using fundamentals and multiples. Okay? So let's look at 3 bank stocks. There's the stock price. Let's see. So here's the stock price. Earnings per share for each bank. And here's the PE, 33 divided by 3, 18 divided by 2, 15 divided by 1. Let's add them up, divide by 3. So we have a low, a high, and a likely multiple. Okay? Here's the book value per share from the financial statements. Okay? Now we have price to book value, 33 divided by 20, 18 divided by 18, and 15 divided by 1050. So we've got a low, a high, and a likely. Okay? Now, look, this is the growth rate of earnings or dividends. This is an estimated number. Okay? Analysts have looked and they think the companies can grow this fast. And so we come up with a new multiple called PE to growth, or the PEG ratio. It's a different way of looking at stock valuation, the PEG ratio. So what we do is we divide the PE of 11 by the growth rate of 10. We just make this a whole number, multiply 0.1 times 100, and so it's 10. Okay? And the PE to growth rate is 11 divided by 10 is 1.1, and 9 divided by 9 is 1.0, and 15 divided by 12.5 is 1.2. So looking at the PE to growth rate, okay, it can change if a stock is expensive or not. Okay? In this case, it really doesn't change it much, although this 15 times is a whole lot higher than 11 times. 1.2 doesn't look nearly as that much higher than 1.1. Okay? So what this shows us is how much we're paying for growth. Okay? And I like this PEG ratio. It's a very useful tool. A lot of analysts and investors over time have looked at new high growth companies. Let's use Amazon as an example. And they said, oh, I'm not paying a PE of 75 for Amazon stock. Okay, so what will you pay? Well, I own Procter & Gamble, and Procter & Gamble is growing at 10% a year, and I would pay 1.5 times that growth rate. I would pay 15, a PE of 15 to get a growth rate of 10. Okay, well, how fast is Amazon growing? 200% a year. Okay, so using your logic, then you would pay 300 times earnings for Amazon. Oh, I would. Yes, you would. You're saying you'd pay 1.5, a PEG of 1.5. And Procter & Gamble's growing at 10%, so you would pay 15. Amazon's growing at 200%, so you should be willing to pay 300. It changes your mindset. It helps you see the possibilities when you look at the PEG ratio. Okay. Then for banks, price to book divided by growth. Not just PE divided by growth, but price to book divided by growth. Okay? And so we've got price to book value of 1.5 and a growth rate of 10%, so 0.15. Okay? And again, we average them up, so we have a low, a high, and a likely. We have a high, and a low, and a likely. All right, now, so this is what the marketplace is telling us stocks, these bank stocks are trading for. This is what people are willing to pay for these bank stocks. All right, now let's plug in information for our bank stock. So we say that Company D, the stock that we're